Welcome back to another video. The S&P 500 is viewed as the poster boy of all investment ETFs. And what I'm discovering is you are really propping up a lot of zombie companies inside the index that are slipping through the cracks. And McDonald's, it's not a zombie company, but it's very close. I have done a deep dive, and looking at the actual financials, it's not looking good. And some interesting information has come out from the Bank of International Settlements. If you don't know who they are the central bank of central banks, high authority in the financial space, some of the highest authority, and they have released a paper in February this year which verifies some of the concerns that I have regarding index investing. I'm not going to make you read the whole paper, right? I'll tell you in a sentence what they have found out. Effectively, what they are saying is companies that are just propped up by the index, passive investments, lenders are starting to view that company as more risky. McDonald's is a great example because this is a company where there's no actual founders or active shareholders with real skin in the game. It's a company run by middle management and corporations. Let's look at the actual shareholders. The majority of the shareholders is Vanguard, BlackRock, State Street. That's normal because that's where all your 401, that's your 401k, that's your ETFs. But they do not sit and read and check the financials and look at the company. The owner can do whatever they want. No one's going to stop them. The other institutions, pension funds, big corporations are keeping this company propped up on the index. So what's wrong with McDonald's? Well, its current net worth is minus 2.16 billion because they decided to take on a bunch of debt and just buy back the stock. Now, some people might say, well, McDonald's is like a defensive stock. Now, I absolutely would not have it on a buy, borrow, die portfolio. How is it supposed to defend your portfolio if it can barely even protect itself? 54 billion in debt. This is a company. It has good margins. It has cash return on invested capital. But it has stagnation. Massive stagnation. Major decline. Over the last 5 years, 19% on the stock price. Just stagnation. Total. This is what your 401k is investing in. Yes, you get a dividend. So they give you your money back and trigger a taxable event. And there's blatant stagnation. Oh, and the Q2 warning. Management explicitly guided for a meaningful deceleration. This is what happens when you invest in a company which doesn't have pricing power. How much can you raise the price of a Big Mac? You're subject to the macro environment. Higher interest rates is what cripples businesses like this. And if McDonald's is showing a little bit of stagnation, can you imagine all the other businesses which are not as strong and powerful as McDonald's is? So we have blatant revenue stagnating, and the entire business model really depends on fleecing the franchisee. So their goal is, let's hope that someone's dumb enough to buy the franchise, to buy a job, because majority of middle class investors cannot understand the difference between revenue, free cash flow, and true cash return on invested capital. So they look at a McDonald's and sit down in a McDonald's and say, wow, this place must make so much money. If I owned a McDonald's, I would be rich. A franchise is the answer. Because, 90% of companies fail in the first 5 years. So let's just take a name, take a big franchise, common belief, and you're buying a job. You're effectively buying a job, and they're going to fleece. The corporation is going to fleece you aggressively. So that is why a company like this is a very fragile to the interest rate environment. And this is what the Bank of International Settlements are saying. Because think of this. If there's active shareholders that actually care, they don't let management do whatever they want. They have a say. They have a vote. But what the Bank of International Settlements have found is lenders and banks are saying this is risky. The inmates are running the asylum. No one's keeping an eye on this. The BlackRock and Vanguard just blindly buy it. People's 401ks just keep it propped up. And it's getting to a point where these companies, the debt could get higher. The cost of the debt could get higher. Right now, they're fixed in a cheap debt because they locked in debt back in 2020 when interest rates were low. But you can see how much cash flow this company will lose if the interest rates, the debt is refinanced more expensive. 5% ties up nearly 50% of their cash flow. 8% rates, 60%, 12%, basically all their free cash flow crippled. $54.9 billion of debt. And they used that just to buy back the stock. That's all they did with it. They're buying back the stock. And what do you get in return? You get a 20% return over the last 5 years. This is one example of so many. This is what index investing is buying. But people are like, I care about being diversified. I mean, right now, McDonald's is more expensive. It's more expensive than the big tech companies right now. The PEG ratio, 4.72. 1 is fair value. If PEG is 1, fair price. But right now it's shown at 4.72. That's extortionate. But yeah, just don't ask any questions. Just buy the index. That's what you're told. If you're going to buy an index, a growth ETF is far structurally superior because the companies that are in a growth ETF have active investors. This is so important. Even the banks and the lenders are looking at this and saying, we want active investors. So if the bank is saying this, the bank is viewing the stock as more risky, why would you buy it? You see? Think about this. If you buy a company, let's imagine you buy a big tech monopoly, but also big investors buy it. Think Ray Dalio, Bill Ackman, Chris Hoyne, the big names, big institutions. They have a lot of weight on decisions that get made. They are protecting shareholders. That's because they're shareholders, they're protecting themselves. But you are in the slipstream. You're in the slipstream of the whales. So they're protecting shareholders. So although when you buy a single stock like a big tech monopoly or an ETF of high growth companies, you're paying zero active management. But you are getting active management because you're buying the same stocks as big institutions are who care. And what the paper is saying is that people are obviously saving money on not getting an active management, but they're finding cracks in passive investment. They're starting to see that companies are just being propped up because of blind buying. There's no more price discovery. Companies are just like McDonald's. sitting with a 23 price to earnings ratio, forward peg of 4.72. Extortionate. You think to yourself, well, how is this possible? This is why. Because it's in the index. If it was not in the index, it would be crushed. Absolutely crushed. So when you're buying these single monopoly companies, that's another thing you need to think of. There's governance, there's active investment. You do not get that on an index. This is where the money's going. Middle managers who care about buybacks, they don't have any incentive. No one has an incentive for McDonald's anymore. Where's the founders? The founders are all long gone. It's a vacuum. It's just middle managers who just think, right, we need to hit earnings per share, so we'll buy back the stock by any means necessary. As long as it stays in the index, that's all that matters. I do not want to invest in these companies, and they're everywhere. The blue chip lie. The blue chip zombies are everywhere. When you're investing in a defensive stock, it still has to have a healthy balance sheet. It has to have free cash flow that is healthy, lack small debt or manageable debt, and most importantly, its financials need to outgrow the cost of your debt. It's not a defensive stock if it cannot compound more than the cost of your debt. You cannot do buy, borrow, die with companies like this. Yeah, this is such a huge misconception. And then people say, well, it's got high dividend. I've already broke this down before. The dividend is just giving you your money back, and you trigger a tax event. The whole point of buy, borrow, die is to not trigger a taxable event. That's the whole point of it. So why would we care? It's not a carry trade. So many investors think it is a carry trade. Well, all you have to do is get a 10% dividend, which we can do that, right? We can invest in a private credit. There's one right on my screen. Right, okay, there you go. Look. So this is the traditional retail view of buy, borrow, die. They think it's a carry trade. All you have to do, there's 10% yield, and borrow at 5%. Boom. This is what your CPA would tell you to do. Yeah. It's a carry trade. Absolutely not. It's not. It is not. You're triggering a taxable event. Your capital growth is not appreciating. It can if you're getting that higher dividend. The laws of capitalism do not allow capital appreciation. The laws of capitalism are just giving you back your money, triggering tax, and you're not doing buy, borrow, die. This is the misconception that so many people think they know how to do the strategy, and I see it all the time on YouTube. People are like, yeah, I'm a genius because I've got 10% yield and I'm borrowing at 5%. I have figured it all out. No, you have not. You have not figured it out. Unfortunately for you, you need capital growth. Capital growth. What is capital growth? There's capital growth. There's just an example. I just pulled up on the screen. That's capital growth. Okay, so if you're borrowing at 4%, 5%, even in a higher interest rate environment, we can still do the strategy. And the company grows and outperforms the debt. We do not prop up the zombies. This is the biggest retail lie ever regarding the index. No wonder it cannot fully outperform monetary inflation year over year. With $54 billion of debt, there's your shareholders' equity. Yeah. That's your shareholder equity in McDonald's. That's your 401k funding that, minus $2.16 billion. I rest my case.